For years, I assumed the most important number for a growth ETF was its past return. I was wrong. The metric that truly matters is one most investors ignore, and it's the key to deciding between two giants like SCHG and QQQM. That feeling of picking the wrong fund is exactly what we're tackling today. We are putting two of the most popular large-cap growth ETFs head-to-head, the Schwab US Large Cap Growth ETF SCHG and the Invesco NASDAQ 100 ETF QQQM. They look similar, but they are critically different in their design and cost. We're going to break down their expense ratios, their core holdings, and their historical performance. And stick with me, because at the end, I will reveal which ETF has earned a spot in my own portfolio and show you exactly how you can use it. You see the tickers SCHG and QQQM, but do you know what's really under the hood? Choosing an ETF without knowing its index is like buying a car without knowing its engine. The engine determines everything: its power, its efficiency, and its reliability. For an ETF, the index is the engine. Let's start with SCHG. It's built to track the Dow Jones US Large Cap Growth Index. Think of this as a wide net cast over the entire US stock market. The index looks at the 750 largest companies and then applies a series of screens to identify those with the strongest growth characteristics. Things like projected earnings growth and historical sales figures. From that broad universe, the SCHG fund then selects and holds about 229 of the top growth-oriented stocks. The philosophy here is breadth and diversification within the growth segment. Now let's look at QQQM. It follows a much more famous and much more focused playbook, the NASDAQ 100 index. This isn't a broad market index. It's a very specific list of the 100 largest and most traded non-financial companies listed on the NASDAQ stock exchange. It holds all 101 of those stocks due to dual-class shares for some companies. The key words there are non-financial. This was a deliberate choice made when the index was created to focus purely on innovation and technology, explicitly kicking out big banks, insurance companies, and investment firms. It's a specialized tool designed to capture the performance of the world's most innovative companies. This isn't a minor detail. It's the single most important difference that dictates everything else. With SCHG, you are buying a broad, diversified portfolio of 229 of the largest growing companies in the United States. It is a wide-angle lens on American growth. With QQQM, you are buying a concentrated, focused portfolio of 101 of the NASDAQ's biggest innovators, with virtually no exposure to the traditional financial giants that make up a huge part of the US economy. It is a zoom lens pointed squarely at the tech sector. What if I told you that one of these funds is nearly 4 times more expensive than the other for holding many of the same top stocks? This is where many investors, even experienced ones, lose tens or hundreds of thousands of dollars over their lifetime without ever seeing the money leave their account. Let's talk about the expense ratio. It's the small, silent fee that an ETF charges every year to cover its operating costs. Think of it as a tiny parasite that relentlessly sucks a little bit of life out of your returns, day in and day out. SCHG has a rock-bottom expense ratio of just 0.04%. That means for every $10,000 you have invested, you're paying Schwab just $4 a year. It's one of the cheapest growth ETFs on the planet. QQQM, on the other hand, has an expense ratio of 0.15%. Now, that's still competitive, especially compared to its much larger older brother, QQQ, which charges 0.20%. Invesco specifically designed QQQM to be a lower-cost option for buy-and-hold investors. But while it's cheaper than QQQ, it is still nearly 4 times more expensive than SCHG. For every $10,000 invested, you're paying Invesco $15 a year. The danger here is that our brains dismiss these numbers as tiny. But this isn't a one-time payment. It's a compounding drag on your portfolio. Let's project this forward, assuming a hypothetical 10% average annual return on a $100,000 investment. After just 5 years, you would have over $880 less in the fund with the higher fee. After 10 years, that gap widens to over $2,800. At the 20-year mark, the cost of the higher fee balloons to over $14,500. And after 30 years, that seemingly insignificant 0.11% difference will have cost you over $56,000. You can't control the market, but fees are one of the few things you have absolute control over. Minimizing them is the closest thing to a guaranteed return in investing. The math is undeniable. SCHG is built for extreme cost efficiency, and over a lifetime, that advantage is enormous. You own SCHG or QQQM and think you're diversified across hundreds of companies. But what if I told you that over half of your money is tied up in just 10 stocks, and that 8 of those top 10 holdings are identical in both funds? Let's get granular, because the overlap is staggering. Both ETFs are utterly dominated by the same mega-cap technology giants. Microsoft, Nvidia, Apple, Amazon, Meta, and Alphabet make up the core of both funds. These are the titans that have driven the market for the last decade. This isn't an accident, it's by design. These are market capitalization-weighted funds. All that means is that the bigger a company's market value, the bigger the slice of the ETF pie it gets. As these giants have grown to trillion-dollar valuations, their influence inside these funds has become immense. For SCHG, the top 10 holdings make up a massive 56% of the entire fund. For QQQM, it's a similarly concentrated 50%. This means that if just a few of those top companies face regulatory trouble or a bad quarter, both of these ETFs will feel the pain significantly, regardless of how the other stocks in the funds are performing. Your real diversification is much lower than the number of holdings suggests. The critical difference is found in the final few holdings and the sector exposures they create. Because SCHG's index is broader and includes all sectors, its top 10 holdings include the payments giant Visa. This reflects its meaningful allocation of about 8% to the financial sector and 9% to healthcare. This gives you exposure to different parts of the economy, how people pay for things, and how they manage their health. In contrast, QQQM's non-financial mandate means it is forbidden from owning Visa. Its top 10 instead includes companies like Costco and Netflix. Chasing past performance might be a trap, but it's crucial to understand how these funds have behaved over the long run. So let's put them head-to-head over 5, 10, and 15 years. Since QQQM is new, we'll use its older sibling, QQQ, as a proxy. Both track the exact same NASDAQ 100 index, so this gives us a fair historical comparison. Here's the breakdown of their average annual returns. Over 5 years, the race is incredibly tight. SCHG returned about 18.2% per year, while the QQQ proxy was nearly identical. Over 10 years, gap appears. SCHG delivered a strong 15.9%, but the QQQ proxy pulled ahead with about 17.7% per year. Over 15 years, the gap widens further. SCHG's return since its 2009 inception is about 16.1% per year. Over a similar period, the QQQ proxy delivered a powerful 19% per year. To understand the volatility you must be prepared for, look at the 2022 market downturn. Amidst rising interest rates and fears of recession, high-growth stocks were hit particularly hard. Both funds experienced major drops from their peaks. SCHG fell about 36%, while the QQQM fell slightly less, at about 32.5%. The key takeaway is that both funds bring serious volatility. A 30% drop isn't just a number on a screen. It's the feeling in your stomach when you check your retirement account and see that you've lost a third of your money on paper. This is the moment many investors make the biggest mistake. They panic and sell at the bottom, locking in their losses. The critical question is whether you have the emotional discipline to stick to your strategy through these deep, painful periods to capture those potential long-term gains. So we've covered cost, holdings, performance, and the psychological challenge of risk. Now it's time to fulfill the promise I made at the beginning. Which of these ETFs has earned a spot in my own portfolio? Based on all the data, the most logical choice for a single foundational U.S. growth fund is SCHG. It's cheaper, it's more diversified across sectors, and it has a proven decade-plus track record. If I were forced to pick only one, that would be it. But the truth is, I own both. This might seem strange after comparing them so intensely, but I use them for two very different jobs inside my portfolio. I use SCHG as the large foundational piece for my U.S. growth allocation. Its purpose is to provide broad, diversified exposure to the U.S. growth market at an extremely low cost. It's the core engine of my growth strategy. Then I add a smaller, separate allocation to QQQM to deliberately tilt my portfolio more aggressively towards technology and innovation, seeking to capture some of that extra growth potential from the concentrated NASDAQ 100. This method of combining funds can be adapted to your age and risk tolerance. This isn't financial advice, but here are a few examples of how you might structure a portfolio, incorporating international stocks with an ETF like VXUS and dividend-focused stocks with an ETF like SCHG. The young investor 20s to 30s. The goal here is maximizing growth. The portfolio is aggressive. 40% SCHG as foundation of US growth, 20% QQQM as aggressive tech and innovation tilt, 30% VXUS for international diversification, 10% SCHD as a small anchor for dividend income. The middle-aged investor, 40 to 55. The goal is to balance strong growth with an increasing need for capital preservation. 20% SCHG as a smaller US growth position, 10% QQQM as a reduced tech tilt, 40% VXUS as increased international holdings, 30% SCHD as a larger focus on stable, dividend-paying companies. The investor nearing retirement, 55 plus. The focus shifts heavily to stability, income, and protecting capital. 60% SCHD. Now the portfolio is anchored by dividend stocks. 30% VXUS to maintain global exposure. 10% SCHG as a small sleeve for continued growth. This structure allows you to systematically adjust your risk while still participating in the market's growth. So that's my take on combining SCHG and QQQM. I'm curious, what's your approach to building a growth portfolio? Let everyone know in the comments. When you're ready, the next video is waiting for you right on the screen.